Look, your favorite mainstream financial experts are flat out lying to you, and it is about time someone had the guts to say it to your face. They want you sitting there terrified, watching the daily market tickers like a manic gambler, checking your portfolio every 4 minutes while the system slowly bleeds your purchasing power dry through hidden fees. Bad advice and relentless inflation. Here is the real deal. The entire traditional banking and financial media structure is built to keep you confused, dependent, and broke. They wrap simple, straightforward wealth concepts in a thick, suffocating layer of pretentious academic jargon just so they can charge you a 2% management fee to underperform the broader market. It is a massive, highly coordinated joke, and the only punchline is your empty savings account. So look, pour yourself a massive cup of black coffee, leave the mainstream financial delusions at the door, and let us have an honest, unfiltered conversation about how real wealth is actually built by normal people in the modern world. I am not sitting here in some pristine high-rise corner office wearing a $3,000 tailored suit trying to sell you an actively managed mutual fund or some complex trash derivative product. I am right here in the trenches with you, just a regular guy who got completely sick and tired of the traditional economic lies, stayed disciplined, engineered a practical strategy, and finally started hitting major financial goals. Think of me as your financial partner or the older brother who already took all the brutal hits so you do not have to. And oh shit, believe me, I took some absolutely devastating hits when I first started out. When I was younger, I thought I was the smartest guy in the room, completely blinded by arrogance and the desperate desire to get rich quick. I threw thousands of hard-earned dollars into highly speculative options contracts, chased hype, up meme stocks that collapsed into dust within 48 hours, and even let a smooth-talking broker convince me to buy high-fee mutual funds that actively destroyed my capital. I watched my account balance plummet to absolute zero more times than I care to admit, sitting awake at 3 a.m. with a knot in my stomach, wondering how I was going to pay rent, the crushing anxiety of feeling completely trapped by a broken economic system while watching everyone on social media fake their way to overnight millions, is something I know all too well, but that brutal, painful failure was the exact wake-up call I needed to finally see through the illusion. I realized that trying to time the market, trading complex options and chasing volatile trends is a guaranteed way to stay poor forever. The real counterintuitive truth about wealth building is that it is incredibly boring, intensely repetitive, and requires a complete mastery of your own psychology rather than some magical mathematical prediction system. True financial independence is not achieved by hitting a 10,000% return on a random microcap asset. It is won through consistent, unyielding execution, living significantly below your means, and ruthlessly funneling every single spare dollar into highly efficient, productive cash generating assets year after year. Let us talk about the crushing reality of our current economic environment, because pretending everything is fine is a luxury we simply cannot afford. Inflation is aggressively eating away at the value of the paper currency sitting in your checking account like a slow-acting poison. The purchasing power of a $100 bill is dropping consistently, meaning if you are just leaving your money in a standard low-yield savings account, you are actively losing wealth every single second of the day. The cost of housing is completely out of control, corporate layoffs are a constant threat, and the traditional promise of working a single corporate job for 40 years to secure a comfortable retirement is completely dead and buried. If you rely solely on your paycheck and a standard corporate retirement account managed by some faceless institution, you are putting your entire financial future at extreme risk. You have to become your own money manager, your own protector, and your own wealth builder. To win this rigged game, you need to implement a streamlined, bulletproof investment architecture that requires almost zero daily maintenance but consistently captures the compounding power of the global economy. Stop looking for the next hidden gem stock and start focusing on broad market exchange traded funds, which we call ETFs. My personal core philosophy revolves around a simple, highly aggressive, three-pillared portfolio structure that cuts out the noise and focuses entirely on long-term capital compounding and cash flow generation. The absolute foundation of this strategy, taking up 70% of the total portfolio allocation, is Vanguard S&P 500 ETF, universally known by its ticker symbol, VO. When you buy a single share of VO, you are not betting on a single company or a volatile tech trend. You are instantly purchasing a fractional ownership stake in the 500 largest, most profitable, most cutthroat corporations in the United States. You are owning Apple, Microsoft, Amazon, Nvidia, and Alphabet, all at the exact same time. Think about the sheer, unyielding power of that corporate structure. These companies employ the brightest minds on the planet, dominate global supply chains, possess massive pricing power to fight off inflation, and are ruthlessly focused on expanding their profit margins every single quarter. If inflation drives up the cost of goods, These corporations simply raise their prices, passing the cost onto the consumer and driving their earnings higher, which directly pushes up the value of your VU shares. By holding VU, you are essentially letting the top 500 corporate entities on Earth work tirelessly day and night to build your personal wealth. The historical track record of the S&P 500 hovers around an average annual return of roughly 10% over long time horizons. If you just park your capital there and let it compound, your money will double approximately every 7 years without you ever having to analyze a single balance sheet or read an earnings report. Now, let us move to the second pillar of the portfolio, which commands a 20% allocation, Schwab US Dividend Equity ETF, or SCHD. This is where we transition from pure capital appreciation to building a defensive, highly reliable passive income machine. SHD does not just chase high, yield junk companies that are fundamentally broken and paying out unsustainable dividends just to attract desperate investors. Instead, South Carolina HD specifically screens for high-quality, fundamentally sound corporations that have a proven historical track record of consistently growing their dividend payouts year after year. We are talking about financial powerhouses like Texas Instruments, Lockheed Martin, Pfizer, and PepsiCo. This component of the strategy leverages the profound logic of dividend growth investing. When the market enters a brutal downturn or a prolonged sideways recession, VO shares might fluctuate wildly in price, which can be psychologically difficult to stomach, but SHD acts as an emotional and financial anchor because those high-quality corporations continue to pump cold, hard cash directly into your brokerage account every single quarter, regardless of what the broader stock market is doing. You take those quarterly dividend payments and immediately reinvest them right back into the fund, buying more shares, which in turn generates even larger dividend payments the following quarter. It creates an unstoppable, accelerating financial snowball effect that builds a massive wall of passive income over time, eventually allowing you to cover your entire cost of living without ever being forced to liquidate your principal investments. The final 10% of the portfolio is allocated to Vanguard Growth ETF, ticker VUG, which serves as our controlled, high-performance growth engine. VUG focuses strictly on massive, fast, growing tech and innovation leaders that reinvest the vast majority of their earnings back into research and development rather than paying out dividends. This gives your portfolio a calculated, aggressive exposure to massive secular shifts, like artificial intelligence, cloud computing, automation, and advanced biotech. By keeping VUG at just 10%, we capture the immense upside of technological breakthroughs without exposing our entire financial foundation to the extreme volatility that typically wrecks undisciplined retail investors. So look at the complete picture. 70% VU for foundational global growth, 20% SHE for cash flow, defense, and dividend compounding, and 10% VUG for controlled tech acceleration. That is it. No complicated mutual funds, no expensive advisory fees, no overtrading, just a clean, hyper-efficient wealth machine that costs next to nothing to operate. But here is the catch. And this is the exact part where almost everyone fails. An elite portfolio structure is completely worthless if you do not possess the psychological fortitude and behavioral discipline to execute it properly over a multi-year time horizon. The modern world is completely obsessed with instant gratification, superficial luxury, and the toxic desire to look rich rather than actually being rich. People will willingly take on massive high-interest consumer debt to buy a luxury vehicle, purchase designer clothing, or live in an overpriced apartment just to impress strangers on the internet. That is a fast track to financial slavery. To build undeniable wealth, you must embrace the philosophy of living significantly below your means, which means ruthlessly separating your personal self-worth from your material possessions. Every single dollar you waste on an unneeded luxury item today is a productive financial soldier you have permanently removed from your wealth building army. You have to develop a deep, almost obsessive respect for your capital. When you get paid, you do not look at your bank account and think about what you can buy. You immediately pay yourself first by executing an automated dollar cost averaging strategy. Dollar cost averaging means you invest a fixed amount of money into your portfolio at regular unyielding intervals, like every single month or every 2 weeks, regardless of what the financial news headlines are screaming. If the market is soaring to all-time highs, your fixed dollar amount buys fewer shares, protecting you from over-investing at the absolute peak. If the market crashes violently and the media is predicting the absolute end of the global economic order, your fixed dollar amount automatically buys significantly more shares at a massive steep discount. You are essentially turning market volatility into your greatest financial asset. Look, the legendary hedge fund manager Ray Dalio talks extensively about understanding economic cycles and removing human emotion from the asset management equation. The average retail investor loses money because they buy when everything is great, and asset prices are highly inflated, driven entirely by FOMO, which is the toxic fear of missing out. Then, when the inevitable economic downturn hits and prices plummet, they panicking, succumb to fear, and sell their assets at the absolute bottom, permanently locking in massive capital losses. They are doing the exact opposite of what builds wealth, buying high and selling low. As a disciplined wealth builder, you have to invert that entire broken psychology. You have to develop a mindset where market crashes, recessions, and economic panics do not terrify you. but instead get you incredibly excited because they represent massive, once-in-a-decade wealth transfers. When the broader market enters a correction and everyone else is frantically selling their positions in a state of blind terror, that is the exact moment you step up to the plate, stay perfectly calm, and aggressively buy high. Quality index funds at a major discount. You must be fearful when others are greedy and incredibly greedy when others are fearful. This journey is not about overnight glamour, and it certainly is not going to make you rich by next Friday. It is a long, slow, disciplined grind that requires you to show up and execute day in and day out, even when the market feels completely stagnant and nothing seems to be happening. But I promise you, if you stay the course, tune out the mainstream media noise, live below your means, and ruthlessly compound your capital into VU, South Carolina, HD, and VUG, the math will eventually take over. The compounding interest curve starts out slow, almost imperceptible. But as the years roll on, it bends sharply upward, transforming into a massive financial tidal wave that guarantees your ultimate financial freedom. Stop waiting for a miracle. Stop listening to the hyped financial gurus and start taking absolute control of your financial destiny right now. Stay cold, stay calculated, stay disciplined, and let us build this wealth together, one single share at a time.